Welcome to This Explainer. If you've been investing for a little while, you've almost certainly run into the classic investor's dilemma. You basically feel forced to choose between income and growth. Bonds will pay you, sure, but they never really grow. And growth stocks? Well, they grow, but they pay you absolutely nothing for years. For decades, investors have been stuck on this incredibly frustrating seesaw. You either picked a bond that gave you a nice yield, but with absolutely frozen growth, or you took a massive gamble on a growth stock that might shoot to the moon but offers zero current yield. We just assumed we had to pick a side and live with the trade-offs. Okay, let's dive into this, because the legendary investor Ralph Block actually spent his entire career proving there is a third seat on this seesaw, and it actually collects rent. As he brilliantly put it, REITs give you the steady, predictable cash flow of real estate leases, but paired with the liquidity of a common stock. His core thesis is that real estate investment trusts, or REITs, completely resolve this whole tension. Section 1, the total return engine. Let's look at how a REIT combines two really powerful financial forces into one single vehicle. A REIT delivers this really unique total return profile. By law, they are mandated to distribute at least 90% of their taxable income as dividends. That's what generates your high yield right now. But here is the absolute kicker. You also get long-term capital appreciation because the underlying buildings themselves gain value and rents systematically rise over time. You literally get paid to wait while the asset you own just continues to grow. Section 2, the velvet rope, institutions only, no more. And this brilliantly illustrates how the real estate market radically changed for the average person. See, it wasn't always this easy for everyday investors to get in on the action. Before REITs, grade A trophy assets, we're talking massive skyscrapers, luxury hotels, sprawling shopping malls, and big industrial parks, they belonged almost exclusively to institutions in the ultra-rich. The barrier to entry was just way too much capital. But REITs completely tore down that institutions-only velvet rope. They pull capital, which means you, the everyday retail investor, now get access to those exact same trophy assets. You get the professional corporate management, you get the institutional level rental streams, and you get it all at pocket money entry prices on the public stock exchange. It's like you're a massive pension fund. Section 3, Living Tree Advantage, Structural Edge versus Bonds. Let's set up a vivid visual analogy to prove exactly why REITs have a structural mathematical edge here. Now, what's really interesting about this slide is how a bond is essentially a plastic fruit tree. It's reliable, sure, you get the exact same fixed 6% yield, the same plastic apples every single season, but the tree never grows. Over a decade, inflation just eats your purchasing power alive. A REIT, on the other hand, is a living tree. You might start with a slightly lower yield, say 5%, but because of built-in rent escalations, that yield actually grows by maybe 3% annually. And crucially, the trunk of the tree itself, the real estate, gains value over time. This gives quality REITs a truly superior risk-adjusted return. But a quick warning here, this only holds for high-quality REITs with sustainable payouts. A junk REIT is worse than a good bond for sure. Let's put some hard math behind that, straight from Ralph Block's research. If you invest $10,000 in a 6% bond, after 10 years you'll have your principal plus the interest, totaling $17,000. But if you put that same $10,000 into a typical REIT with a 5% yield and 5% annual growth in its cash flow and dividends, your total investment value hits $22,579. That is a massive difference of $5,579, and it's all because you chose the living, growing tree over the plastic one. So, I want you to say it with me. Let's fill in the blanks here. A REIT's total return equals current yield plus capital appreciation. If you can name both of those engines, you will never make the beginner mistake of buying a REIT purely for its yield while completely ignoring the health and growth potential of the underlying buildings. Section 4, FFO, the real metric. Time for a quick pivot, because there's a bit of a dirty secret we need to uncover. The standard net income profit figure that REITs report, it's basically wrong, and the professionals completely ignore it. Instead, they look at FFO, or funds from operations. This is the true metric that reveals the actual cash-generating power of the trust. It strips away all those misleading accounting illusions that traditional net income creates, giving you a crystal-clear look at the cash that's actually flowing into the business from regular, ongoing activities. Here is exactly how you calculate it, step by step. Step 1, you start with standard net income at the very bottom of the income statement. Then, step 2, you add back depreciation and amortization. Why do we do that? Well, because standard accounting rules force companies to pretend that buildings erode and lose value over time, exactly like factory machinery does. But we all know that in the real world, well-maintained real estate usually appreciates. Finally, step 3, you subtract any one-time gains on the sales of property, because we only want to measure the regular, ongoing, recurring rent checks. This formula gives you the true operating performance of the REITs. Section 5, Space Market Cycle, Timing Your Investment. This is the final professional tool you need to master REITs, because knowing what to buy just isn't enough. You absolutely must know when to buy. Every single commercial property market on Earth rides this endlessly repeating 4-phase wheel. Year 1 is the depression phase. You've got high vacancies, low rents, and heavy concessions to tenants. Nobody is building anything new. Eventually, demand returns, and that leads us to Year 3, the recovery phase, where occupancy slowly rises and rents finally start to stabilize. This builds real momentum into Year 6, the boom or expansion phase. Rents climb sharply, profits are huge, and suddenly you see construction cranes popping up everywhere. Which, of course, inevitably leads to Year 9, overbuilding. All those brand new buildings finish at the exact same time. The new space completely outruns demand, vacancies rise, and rents fall, bringing us right back to the beginning of the wheel. You really have to know where your target property sector sits on this timeline before you deploy your capital. So looking at your own portfolio today and applying your new understanding of total return, FFO, and these market cycles, which phase of the space market cycle are you buying into right now? Keep that provocative question in mind as you plot out your next big move. Thanks so much for joining me for this explainer, and I'll catch you in the next one.